Welcome to Real Estate Economics weekly webinar series. Real Estate Economics is a leading provider of residential market consulting and online research tools, serving the building industry, developers, landowners, and interested real estate parties. Every week we provide a webinar posted to YouTube at 9 a.m. Covering a variety of topics or market areas. Some weeks we'll cover the nation, perhaps a state or a large region. Sometimes it's a smaller MSA or county area, and sometimes it's a special topic or an area of special interest. This week we're going to look at housing product identification for land acquisition, and in this analysis we'll look at how product can be derived and applied to a quick, simple, and direct, cost-effective land residual to make some quantitative and qualitative judgments about the quality of a potential land acquisition prospect. And we'll be using the Clovis area as a case study. This is the upcoming schedule. In 1 week, we'll be covering the Las Vegas, Nevada region. 2 weeks from now, we're going to provide a special topic: what are the financial markets telling us about housing market economics? And there we're going to look at a variety of non-housing related indicators to bring those back and make some judgments and form some opinions about housing market economics over the next quarters, months, and years. To start today's series, we're going to look at the current market conditions on the ground in Clovis. That'll give us a little bit of idea about the present situation, just so that we can establish really an overview, a current setting for what takes place. This particular exhibit is from Real Estate Economics Housing Transaction Report, and this shows in the colored dots conventional resales shown in blue, new home sales in green, foreclosures, that's owner back to lender, and foreclosure sale, that's lender out to new third-party owner, transaction activity for Clovis zip codes only for the period from January to May 2010. You can see in this that there's a very limited number of new home sales, a fair number, about a 40% market share attributable to conventional resales, and about a 30% market share each going to foreclosures and foreclosure sales. Let's see how that breaks down in greater detail. What's the nature of this sales activity? Here you can see that the overall volume in the center of the screen has been fairly consistent from 2 years ago at 930 to a year ago 847 and 877. This again covers a 5-month period, so we can do the math there on a monthly basis. Conventional resales were about 32.6%. They've been coming up as more and more short sales are falling into this category. So gradually over time, some of the distressed activity, the foreclosure sales, and some of that is coming back to the conventional resale side as lender approved short sales. If you look at the new home, conventional subdivision sales in green, that number's dropped off from 16.7 2 years ago, which is really a pretty healthy number if you look at what's typical in the state and in the nation, down to 7% new builder sales a year ago, now down to 4.3%. In most markets, we would consider, just as a rough metric, about 10% builder sales volume. If there's less than that, we'd consider that to be an area of opportunity. We can probably go into a market with less than 10% and find some niches and find some viable market positions. As you can see in the distressed area, the volume has been pretty good. There's landlord types, remodelers, flippers, rental investors are pretty active in this market area. Prices have fallen far enough that it's possible to buy a foreclosure from a bank, remodel that, or in some cases barely upgrade it and get it back on the rental market in a short amount of time with a positive cash flow. So landlord investor types, are very good at this. They're very experienced at this, and they're on top of what's coming back to the market in terms of lender-owned property. At the bottom of this particular exhibit, you can see that the single-family homes really dominate this area. As prices have come down for single-family homes, there's really less and less motivation to accept a condominium as an owner-occupant, and probably still less motivation to build it as a conventional builder. Look at the effective prices here. You can see that prices have come down quite a bit from 2 years ago, but show a little bit of stabilization year over year. Short sales tend to be in much better condition typically than lender-owned foreclosures, so that brings a little bit higher price points. And the fact that some of these units are transitioning straight from the distressed owner out to short sales has given us a little bit of price support. You can see a little bit of improvement in the new builder sales prices. That's in part due to the older legacy homes not selling that well, and so there are more higher priced homes still on the market and fewer of the high selling, stronger sales volume homes that tend to be at lower price points. And again, you can see really a widening gap or a bigger deceleration in condominium prices in this market. What are the effective price ranges here? Shown in yellow is the period 2 years ago. If you look at those bars, there was quite a bit of transaction volume in the 300 and on up price range. 400 to 500 and 500 plus were pretty vibrant in those days, and there were good opportunities, especially northeast of Clovis out in the Albury direction, to put some larger ranch style homes and some move up product. The market's really retreated from there, and a lot of the volume has migrated back to the lower price points. We would really like to see new home opportunities here under 400. It's very difficult to deliver anything. We recognize under 150, a little capacity from the 150 to 200, but not much. So really the 250 to 350 is the price range we'll be examining more carefully this morning. Here's another way to look at the viable price ranges. These are sales numbers and percentages by price range shown from 2 years ago to a single year ago to the current period. I've highlighted here every bracket that has over 4% market share. You can see 2 years ago, even up at 400 to 499, there was 4% market share. The 500 to 549 had 3% market share. The volumes in those upper price bands have really eroded, and now the high velocity price brackets are in the 100s, 200s, and 300s. Obviously, we can't build a program at some of those lower price points. Those are older homes and a lot of not as desirable neighborhoods, in some cases smaller homes, some cases highly depreciated. But we believe we can still deliver some product in the 300 to 324 and some of those price ranges that the market will accept. So what do we know so far? The transaction volume is high enough to support new home sales, and the percentage of sales that are currently channeling into new homes is lower than we'd like to see, telling us that there's probably some market opportunity. New homes can be delivered at prices that are not overstated relative to resales. We saw that in the price activity and the sales prices for new homes. Sales volume has migrated out of most higher price points. We saw that in the last graphic. New homes still, though, enjoy a sizable price premium to resales. There are many advantages of new homes that lead buyers in that direction. If you think about an existing neighborhood, no one's quite certain the condition of the buyers or the current residents in that neighborhood. Are those people about to be foreclosed? Are they behind on their payments? Are 10 or 20, 30 or 40% of the people in an existing neighborhood not going to survive the next year or two and short sale or conventionally sell those homes, leading to lower values? If you look at a new neighborhood, everyone's been recently qualified for a loan, qualified with fairly high standards, and you have much higher certainty that the values are stable. Plus, there's abundant advantages in terms of construction and other areas. That's part 1 of 3. Please, if you're watching the whole series today, make sure you see all 3.